April 2019, San Jose Airport, California. A private Gulfstream G650 touches down. On board is Adam Neumann, co-founder of WeWork. He steps through the terminal carrying a single leather case. Inside, cash, tequila, and the faint smell of smoke. He's flown in to close another deal. Back in New York, the company he helped build is starting to fall apart. Employees are getting layoff notices. Investors are asking hard questions. A $47 billion paper valuation is shrinking by the week. How did a company that promised a new way of working become a headline for excess and failure? How did one man walk away with a fortune while thousands lost their jobs? This is the story of WeWork, hype, hubris, and a founder who became the brand. We go back to 2010, New York City. Two former roommates open a shared workspace. The idea is small and practical. They rent a big office, renovate it, and divide it into small spaces. Startups, freelancers, and small teams move in. It works. People like it. But Adam Neumann, one of the co-founders, tells a bigger story. He doesn't sell square footage. He sells meaning. Community, he says. A new way of life. He speaks like a preacher. He walks barefoot. He quotes philosophers. He becomes the face of the company. The media love him. Thought pieces call him a visionary. Investors start writing checks. A venture firm gives WeWork an early $17 million seed round. That money fuels expansion. From New York, the company spreads fast. Boston, San Francisco, London, Tokyo. Every new office is a billboard. Every billboard costs money. Rent, renovations, staff, furniture. Growth looks impressive in slide decks, but it is expensive in real terms. By 2018, the books tell a blunt story. WeWork reported a net loss of about $1.6 billion that year. Cash burned fast. Leases piled up. Revenues could not cover the costs. Yet the public message stayed the same. Losses are investment. Scale is the priority. We are building the future, the narrative went. The company dressed itself as tech. The pitch compared WeWork to Uber and Airbnb. But underneath, it was rental real estate with an expensive brand layer. That distinction mattered when WeWork filed for an IPO. In August 2019, the company filed its S-1 with the SEC. For the first time, the public saw the raw numbers, losses, related party transactions, and governance red flags. The S-1 exposed deals that raised eyebrows. The founder's control was unusually broad. Related entities leased buildings to the company. Neumann had sold trademarks to his own firm and then licensed them back. Public scrutiny came fast. Journalists from the Wall Street Journal, New York Times, and Bloomberg published stories. Analysts and investors dug into the fine print. Confidence eroded. The hype faded. Then the rescue drama began. SoftBank, the Japanese conglomerate led by Masayoshi Son, had already poured billions into WeWork. When the IPO collapsed, SoftBank negotiated a multi-billion-dollar rescue package. Reports varied, but the package was often described as worth roughly $8 to $10 billion in commitments and financing to stabilize the firm. One condition of the rescue: governance change. Adam Neumann would step down as CEO. In October 2019, he resigned, but he did not leave empty-handed. Media reports at the time said his exit deal and related transactions were valued at around $1.7 billion. That headline number shocked many. How could a founder leave with that while employees were being laid off and investors lost money? The answer is messy. Neumann had equity, and some transactions were structured to provide him cash and liquidity as part of the rescue. Critics called it a golden parachute. Defenders said it was part of the negotiated settlement to keep the company alive. Either way, the optics were brutal. Layoffs followed. Buildings were closed. Projects were canceled. In 2019, roughly 2,400 employees received layoff notices in one round of cuts. One of the most visible blows to the workforce. SoftBank injected tens of billions across multiple transactions to shore up operations. It forced WeWork to pull back from ambitious projects, residential complexes, private schools, and a raft of side ventures that had little revenue. Those projects had been used to justify valuation. They were expensive and often unprofitable. One striking pattern emerged: related party deals. Properties owned or controlled by insiders were leased to WeWork. The founders' transactions with the company raised conflict of interest concerns that mattered to investors and regulators. And then the pandemic hit. Remote work accelerated. Demand for shared office space changed. WeWork's recovery was harder. By 2023 to 2024, the company had closed hundreds of locations, shrunk its footprint, and restructured leases. It reorganized under new leadership and tighter governance. WeWork did not disappear, but it lost its aura of revolution. So what exactly went wrong? There is no single answer. Multiple failures stacked up. First, product versus pitch. WeWork sold an idea, not just desks. That idea can be powerful. But investors paid tech multiples for a business that behaved like a long-term landlord with huge fixed costs. Second, unchecked growth. Rapid expansion hid the weakness of unit economics. Every new site added fixed obligations long before revenue stabilized. Third, governance and conflicts. When founders have concentrated control in related transactions, oversight weakens. Boards must ask hard questions. Here, the board sometimes failed to do so. Fourth, culture. Inside WeWork, the culture tilted toward worship of the founder, standing ovations after speeches. A cult of personality made critique risky. And finally, incentives. Some investors rewarded growth at all costs. Some executives cashed out at the peak. That combination can produce both boom and break. What about legality? Neumann faced civil suits and heavy criticism, but not criminal conviction for fraud tied to the IPO filings. Regulators, investors, and civil litigants pursued claims over disclosure and governance. Some settlements were reached. Some questions remain in court documents and reports. But the broader picture is institutional. Markets, regulators, and corporate governance all needed harder edges. What happened to the money? Who benefited? Founders, early investors, and service providers captured value along the way. Some employees and private investors lost. SoftBank absorbed huge losses to protect its larger strategy. The communities where offices closed lost tenants and local spending. Small businesses that relied on WeWork traffic felt the pullback. The human cost is the clearest and most painful story. Thousands of workers lost jobs. Small startups pushed out of leases. People who believed in the mission found themselves laid off with little warning. And yet, from a purely financial view, some people walked away with fortunes. That duality is the paradox of modern startup culture. Enormous upside for some, enormous risk for others. What have we learned? First, charisma cannot replace fundamentals. Great storytelling needs to be backed by viable unit economics. Second, valuation is not a moral endorsement. A high paper valuation is not the same as sustainable revenue. Third, governance matters more than ever. Boards and investors must police conflicts and ask for clear metrics. And fourth, customers and employees deserve protection from the collateral damage of fast expansion. WeWork today is smaller and more cautious. It rents fewer desks. It runs leaner operations. It survived, but the revolution it promised has been deferred. Adam Neumann remains a complicated figure in the public eye, visionary to some, reckless to others. He left in 2019 under terms that many still debate. For many people, the story is a simple cautionary tale. Beware the founder who promises salvation and asks you to invest before the math is checked. For regulators and investors, it is a call to tighten oversight. For employees, it is a warning about building your life around an unproven dream. And for the market at large, it is a reminder: hype can last a long time, but it rarely covers costs forever.